Hi everyone, how are you? I hope all of you are doing really good. So welcome to another session of financial management, and in this session we are going to take up the ICAI mock test paper of January 2025 attempt set number 1 discussion. Let's see, we have some really good questions and some really easy questions also. So let's get started with the case study part, right? The MCQ and the case study part we are going to discuss. Question number 1. Small bus companies into manufacturing minibuses. Since the establishment, it has seen a phenomenal growth in both the market share and the profitability. The financial statements, that is P&L and the balance sheet, are shown below. The company enjoys the confidence of the shareholders, who have been rewarded with the growing dividends year after year. Last year too, the company had announced 20% dividend, which was the highest in the automobile sector. The company has never defaulted on the loan payments and enjoys a favorable phase with the lenders, which include the financial institutions, commercial banks and other private debenture holders. The competition in the bus industry has increased in the past few years, and the company foresees the further intensification of competition with the entry of several foreign bus manufacturers, many of whom are the market leaders in their respective countries. The minibus segment especially will witness the entry of foreign majors in the near future, with the latest technology being offered to the Indian customers. Small bus companies management realizes the need for the large-scale investment in the upgradation of technology and improvement of the manufacturing facilities to beat the competition. So, it is just the whole story, sir. Right? It is just the storytelling, nothing as such relevant as of now from our point of view. The only thing that is relevant is this line: management realizes that need for the large scale investment will be required for the technology upgradation, because the competition in this particular bus segment they are forcing. While on one hand the competition in the industry has been intensifying, on the other hand there has been a slowdown in the Indian economy, which has not only reduced the demand for the buses but also led to the adoption of price cutting strategies by the various bus manufacturers. Also, not as such in terms of numbers it is not going to be relevant for us, right? The first two paragraphs, in terms of the numbers, if we talk about financial management, it is not going to be relevant for us. Let's further see. The company needs 3,12,50,000 for investment in technology and improvement of the manufacturing facilities. Now from here the main part of this question will start. The company has three options for the funds. Now they want to raise this money, 3,12,50,000. Fine, sir. How they can raise the money? First option is the company may issue 31,25,000 equity shares of rupees 10 each. Raise the money, sir. The second option is they may issue 15,62,500 equity shares of 10 each and 1,56,250 debentures of 100 denomination bearing 9% rate of interest. That means the debt equity here will be 1:1. In the equal proportion, they will raise the money through equity as well as through debt. Fine, sir. The company may issue 15,62,500 equity shares of 10 per share and 1,56,250 preference shares of 100 bearing 10% rate of dividend. So these are the three options which are available with the company. The company's earnings before interest and taxes after the investment is 37,50,000. That is the EBIT that is given to you. The income tax rate applicable is 40%. Based on the above facts, the management of the company asks you to answer the following questions. Now see, what is actually the relevant part in this? The relevant part is only this much, sir. The relevant part is only this much. Rest, the first two paragraph is just the story which actually we will not be requiring, right? So let's see what is the requirement now. MCQ 1, what is the EPS under the financial plan 1? What is the financial plan 1? This one, where the money is going to be raised through equity shares. You need to calculate what? EPS. Very simple, sir. What is the EBIT that is given to you? How will you calculate here, sir? EBIT is given as 37,50,000. Right? On this there is no interest. Directly you will pay what? Tax, sir. 40% tax. You will get what? No preference dividend. Earnings after tax or residual earnings divided by number of equity shares, that is 31,25,000. 31,25,000. You will get EPS, sir. So 37,50,000 minus 40% divided by 31,25,000, that comes to 0.72. Straight away 0.72. Now in the examination, sir, for the EPS, are we required to prepare income statement? Why, sir? Why do you require, are you going to show the calculations for the MCQ part? No, just do it directly in a statement quickly, because we don't have time too much to solve, make the income statement, all those. No need, sir. Do it like this. Now you are a pro in the financial management. You have made many statements. Now you know. The next is the EPS of the financial plan 2. Another very easy, sir. What will be the financial plan 2 where 50% is equity and 50% is what? Debt, sir. Now, on this, what will be this 37,50,000? Out of this, first you will pay what? The interest on debt. Interest on debt will be how much? 9%. 9% of what? 1 crore 1,56,250 into 100 into 9%, that comes to 14,06,250. 14,06,250. Now on this you will pay a tax rate of 40% divided by how many shares? The shares will be 15,62,500. Please be very careful here. Do not take the shares as in the first part. 37,50,000 minus 14,06,250 divided by 15,62,500. That comes to 0.9. Is this the correct answer? C part 0.72, 0.9. Correct, sir. Third part, EPS under the financial plan 3. What is financial plan 3? That is 50% equity, 50% preference shares. Now what will you do, sir? 37,50,000. On that, first you will pay dividend, sir. Let's first pay preference dividend on this 37,50,000. Are you going to pay dividend? No, sir. On this EBIT, first we are going to pay what? First we are going to pay tax on this. On this, first I am going to pay my tax of 40%. After paying tax, I will pay a preference dividend. What will be the preference dividend? That is 10%. 1,56,250 into 100 into 10%, sir. 15,62,500 minus 15,62,500 divided by the number of shares, that will be 15,62,500, right? So on 37,50,000, I will pay 40% tax minus 15,62,500 divided by 15,62,500, that comes to 0.44. The answer is there, sir, 0.44, correct? So EPS calculated for all the three options. Any doubts in this thing? EPS calculated for all the three options. Easy, sir. What is the EBIT-EPS indifference point by the formula between the financial plan 1 and financial plan 2? What is an indifference point, sir? Indifference point is where the EPS of the financial plan 1, it is that level of EBIT. What is an indifference point? It is that level of EBIT where the EPS of the plan 1 will be equal to EPS of the plan number 2. Fine, sir. How will you calculate between the plan 1? It will be the EPS of plan 1 is equal to EPS of plan 2. We have to calculate what? The EBIT level. So EBIT into 1 minus tax, that will be plan 1 divided by number of equity shares, right, equal to EBIT. In the second plan we have interest, so I will first pay interest into 1 minus tax rate divided by number of equity shares, right? So here you have to calculate what? EBIT into 1 minus 0.40 divided by what is the number of shares in the first case? It is 31,25,000 shares. 31,25,000 shares is equal to EBIT minus interest. How much is the interest amount that we have calculated here, sir? 14,06,250. 14,06,250, right? On that I will pay 40% tax divided by number of equity shares will be 15,62,500. Now solving this, you have to find out the values of EBIT. That's it. Will you be able to do it? Solving this, you have to find out the value of EBIT. This will be, I think, 2, right? Directly we can take it 2, take the 2 here, multiply it and then solve it, sir. Will you be able to do it, sir? It will be 0.60 EBIT is equal to 2 into 0.60 EBIT minus 14,650 into 0.60, that comes to 8,43,750. Please solve from this particular level. Oh sir, solve na sir. Okay, you guys are like, you want a spoon feeding, isn't it? Yes sir, we love spoon feeding, sir. That's what we are made for. Oh, okay, 8,43,750 into 2, that is 16,87,500. So, oh, okay, so 1.2 EBIT minus 0.6 EBIT is equal to 16,87,500, and that will be, EBIT will be how much then? EBIT will be divided by 0.6, 28,12,500. Hopefully the answer is correct, sir. Okay, they have taken it in points, huh? 28 lakh. Why? Number of equity shares, we have taken it correct, and tax rate is 40%, no? Let's see how they have calculated. Let's see. Yes, sir, it is fourth. Okay, fourth, yeah, fourth is correct, sir. I was looking answer for fifth. Yeah, fourth is correct. Done. A part, 28,12,500. Exact we have calculated. Clear? Done. Okay, so fifth part will be your homework now. Fifth part will be your homework, where you have to calculate the indifference point between financing plan 1 and financial plan 3. Clear? So this is done with the case study, the easy case study. This was one of the easiest case studies, I would say, which we have seen in the past RTPs, MTPs, right? This is one of the easiest case studies that we have come across. Yes, sir. Okay, let's move on to the next one. The second MCQ. Fourth, fifth, we are done. Let's come to the second one. A company has a degree of operating leverage of ₹2 and the financial leverage of 3. If the sales of the company increase by 5% during the next quarter, the EPS will increase by how much? Which leverage tells us the relationship between sales and EPS? Combined leverage. So combined leverage will be operating leverage into financial leverage, that is 2 into 3, 6. So combined leverage is what? The percentage change in EPS due to percentage change in sales. That's how we read the formula. Percentage change in EPS due to percentage change in sales. Now percentage 6 is equal to percentage change in EPS divided by 5. So percentage change in EPS will be how much, sir? 30%, right? B 30%, correct? Solution done. Quickly done, sir. Let's move on to the third part, third question. The following are the data on the capital project being evaluated by the management of Amal Limited. The annual cost savings is given 1,80,000. The word given is savings. The useful life is 5 years. IRR, internal rate of return, that is IRR, is given to you as 10%. Salvage value 0, present value factor. Okay, make the correction here. Even in the institute that is given wrong. It is at 10% for 5 years. Right, in the institute MTP itself it is given as wrong. The present value annuity factor, this 3.79 is at 10% for 5 years, and that is what we require. He says based upon the information, calculate the payback period of the project. Calculate the payback period of the project. Now for this payback period, what we need? Sir, he is not asking about the discounted payback period, he is asking about the simple payback period, and for that what we need is the cash inflows and the cash outflows. Fine, sir. Now the IRR is given to you. What is IRR, sir? At this particular rate 10%, your present value of cash inflows is equal to present value of cash outflows. Do you agree with this thing? Yes, sir. The cash inflows are what? This is your cash inflow, the saving. Annual cost saving is a deemed cash inflow. So I can write this cash inflow as cash inflow multiplied by present value annuity factor at 10% for 5 years is equal to present value of cash outflows. Cash inflow is how much? 1,80,000 multiplied by present value factor is how much? 3.79 is equal to PVCO. Right? So this will be 1,80,000 multiplied by 3.75. 6,75,000 is your cash outflow. Sir, if nothing is mentioned, this cash outflow is assumed to be at 0 period. Right? If nothing is mentioned, the cash outflow is assumed to be at which period? 0 period. So this is my cash outflow at 0 period. What is my cash inflow? Because I do not need the present values. He is asking about only the payback period. I need only the cash inflows and outflows. Cash inflow is how much? 1,80,000. Right? So in how much time I will be able to recover this amount, sir? In how much time I will be able to recover this amount? See, clear? Okay, there is some issue with this. 1,80,000 into 3.79. Okay, sir, it is 9. Sorry, it is 9 here. So this figure will be different. That is 6,82,200. Right? So dividing the cash outflow divided by cash inflow will give me the payback period, sir. That is 3.79. 3.79. Right? So this is how the payback period is to be calculated. Important. Good one. Let's come to the next one. Fourth one. Under the Modi-Giuliani-Miller dividend irrelevance theory, the company has rupees 1 lakh to distribute. If it chooses to retain the earnings instead of paying the dividend, what happens to the shareholders' wealth? Sir, what is the name of the theory it is given? It is dividend irrelevance theory. What is saying, sir? Irrelevance theory. Sir, if the name is saying irrelevant, what does it mean? The theory of the dividend says, sir, whether you pay the dividends or whether you retain the money and do not pay dividends, it is not going to impact the wealth of shareholders. It is not going to impact the price of the share. That is what we have learned. The whole derivation I have told you, isn't it? That whether you pay dividend or whether you do not pay dividend doesn't matter. Doesn't matter, sir. Clear? So he says, remains unchanged because the value depends upon the earnings and the investment policy does not depend upon the dividend distribution. And the name of the, the answer is given in the question itself. The dividend irrelevance theory. What is irrelevance, sir? Dividend pay or not pay doesn't matter. It is irrelevant to us. Clear? Done with question number 4. Come to question number 5. ABC Industry is a mid-sized company manufacturing. Okay, this question number 5 is basically now the MCQ part is over, the practical part, right? I have arranged it in the direct way. Okay, question number 5, I have arranged it in the direct way. You will get the part B, second part, question number 1. 5. ABC Industry is a mid-sized company manufacturing what? The consumer goods. Last quarter, the company reported the sales of 2 lakh rupees. The production process involved the significant variable cost which account for 50% of the sales value. Additionally, the company incurs 40,000 as the fixed operating cost for the rent, utilities and management expenses. ABC Industry has borrowed the funds leading to 10,000 as annual interest on the long-term debt. The company is currently planning to launch a new market campaign aimed at boosting the sales by 10%. As a financial analyst of the ABC Industry, you are required to calculate the combined leverage and illustrate the impact of 10% sales increase using the combined leverage. He says, first calculate the combined leverage, sir. Very simple, sir. Combined leverage is what? Sales minus variable cost will give you what? Contribution. Contribution minus fixed operating cost will give you what? Will give you what, sir? EBIT. EBIT minus interest will give you what? EBT. And EBIT and EBT will give you what? Combined leverage. Right? I will give you what? The combined leverage, sir. So sales minus variable cost, contribution minus fixed, EBIT less interest taxable, that is EBT. Combined leverage is what? Combined leverage is what, sir? Okay, combined leverage is, sorry, contribution by EBT, sir, not EBIT, that is financial leverage. Contribution by EBT, 2, right? It is 2 now. And the second part says the impact, what is the, illustrate the impact of 10% sales increase using the combined leverage. Combined leverage tells us what? The combined leverage is percentage change in EPS due to percentage change in sales. Combined leverage is 2, percentage change in EPS divided by percentage change in sales is 10%, right? So what will be my percentage change in EPS? That will be 20%. So the impact here is that if you change your sales, your EPS will change by double, twice, right? You are changing the sales by 10%, your EPS will change by 20%, right, sir? Done with the A part, very easy but good one on the leverages. Second part, come to the B part, sir. P Limited has the following capital structure at book value as on 31st of March 2024. Equity share capital is given 1 lakh shares, rupees 10 lakh, 12% preference shares are given, 10% debentures are given, total 40 lakh rupees. The equity shares of P Limited are currently traded at rupees 100 per share. The company expects to pay a dividend of rupees 5 per equity share next year. So it is the D1. With the dividend projected to grow at 5% per annum. Growth is how much? 5%, sir. Corporate tax rate is 35%. Calculate the WACC based on the current capital structure. Can you not do it, sir? Very easy, sir. What will be the KE? The KE will be D1 divided by price of the share plus growth rate. D1 is given 5 divided by price of the share, it is given 100. Growth rate is given 0.05. So 5 divided by 100 plus 0.05, that comes to 10%. KE is 10%. What is KP? KP is given, sir, 12%. And what will be the KD? That is 10% into 1 minus tax rate, 6.5%. Rest, the book values are there, nothing else to be done. The book values are there, nothing else to be done, sir. Easy, you can do it. Book values are done. Weightage you have to calculate. What will be the weightage here out of 40 lakhs? So 10 lakh divided by 40 lakhs, that will be 0.25, right? And 15 lakh divided by 40 lakhs will be 0.375 and 0.375, right? Multiplied with what? The KE. KE is we have calculated as 10%. KP is 0.12 and it is 0.065. So that will give you the KO. That will give you the overall cost of capital, sir. Easily you can calculate. The second part of the question says, recalculate the WACC if the company raises an additional 5 lakh rupees of debt by issuing 12% debentures. This change will result in an increase in the expected dividend to 7, D1, with the growth rate remaining the same, the decrease in the market price to 90 per share. Now there will be two changes. One, the KE will be calculated again, that is 7 divided by 90 plus 0.05, right? So 7 divided by 90 plus 0.05, that comes to 12.77% or 78%. Secondly, you will have to calculate KD2, that is the fresh KD, this on this 5 lakh rupees, 12% into tax rate, right? That will be 7.8%. The KD, the second KD. Rest of the things will remain same. Now 10 lakh, 15 lakh, 15 lakh and 5 lakh and 5 lakh. 12% debentures, 5 lakh. Calculate the weightage, KE, KP, KD1, KD2, done. Clear? Easily you can calculate, sir. Now this part we have done. In the second part we have calculated the KE again and the new KD, KD2 basically. KD2, call it as KD2, KD1. This way you can call it, nothing to worry as such. Done? So question number, this B part is done, sir. B part is done. Come to question number C part. This only, question number 5, C part. Vyom Limited, an IT conglomerate, is planning to take over Aryansh Limited, a startup company incorporated 2 years ago but holding a lot of prospect. To determine the buyout consideration, the Vyom Limited has approached you as the finance controller to estimate the fair value of the startup company today Based on the future earning estimates, the following details of the startup company are as follows. So when you want to know this particular, you want to know it at 0 period, and it will depend upon what? They want to know the fair value of the consideration, that if at today we want to buy that company, what should be the amount that we should be paying, right, for the purchase consideration based on the future earnings, 1, 2, 3, 4, 5, whatever the years we will see. The expected sales in the coming year are 25 lakhs with the PV ratio of 40%. So here he says first period the sales is going to be 25 lakhs and PV ratio of how much? 40%. So can you tell me what will be the contribution here, sir? Contribution will be into 40%, that is 10 rupees. Okay, fine, sir. The sales are expected to grow. The sales are expected to grow at a rate of 20% for the next 2 years. So what will be the sales at the end of this period? 2-3 years, right? So what will be the sales here? 25 lakhs plus 20%, that will be 30 lakhs. And here it will be again growth by how much? 20% plus 20%, it will be 36 lakhs, right? Next, to 40% for another 2 years, and in the next 2 years, that is year number 4 and 5, it will grow by how much? 40%. So what will be the sales here, sir? 36 plus 40%, that is 50.4, and plus 40%, that comes to 70.56. So what will be the contribution at this level, sir? Contribution here, contribution here, contribution here, and contribution here. We'll see, sir. And then he says 25% in the 6th year. Okay, there is 6th year also. Oh, great, sir. There is also 6th year. Here, what will be the sales? It will grow by 25% plus 25%. It will be 88.2. Right? I am just breaking down whatever the question is given to you to make it easy for you people. And thereafter, the cash flows will grow at a steady rate of 10%. He says after 6 years now, after 6 years for the infinite life, the growth will be at 10%. The sales or the cash flows will grow infinitely at the same rate, that is 10%. How many years? We don't know, sir. Okay. Now, the fixed cost of the upcoming year is expected to be 12 lakh for the first 2 years, 10 lakhs thereafter. Okay, for the first 2 years, he says the fixed cost is going to be 12 lakhs. Here also fixed cost 12 lakhs. Then it is going to be 10 lakhs. 10 lakhs, fixed cost 10 lakhs, fixed cost 10 lakhs, sir. Okay, sir, fine. Next, the loss in any year can be set off against the profits of the immediate next year. The corporate taxes applicable are 25% and 20% to Vyom Limited, that is the company which is purchasing, and Aryash Limited respectively. The Vyom Limited's desired rate of return is 15% and the cost of capital of Aryash Limited is 17%. As a finance controller, calculate the fair value. Fair value means here you want to calculate the fair value. What will be the fair value, sir? The fair value will be what? Here you will calculate for all these years, you will calculate what? You will calculate the CFAT, sir. You will prepare the statement, you will calculate the present value of CFAT, right? Present value of CFAT, that we will take it here, sir. When you will calculate the present value of all the future cash flows, I am talking about up to 6 years. First, up to 6 years, you calculate CFAT, calculate the present value of those CFAT, the total of that will be a part of fair value. Let's see what they have done here is, I'll show you the fair value of the company. See, cash flows for the first 6 years they have taken first. For the first 6 years, we are going to take contribution. They have taken 40% on the sales. They have taken directly contribution. I have shown you the sales also. Minus the fixed cost, net profit before taxes, there is a loss. Now loss, either you can set off from here, but in that particular year, there is no profit. So they have set it off from the 3rd year. Wherever the next year means wherever the profits are available in the immediate next year. In that year, you can set off, right? losses set of taxable income, taxes, cash flow, and the present value of cash flows at what rate now? The rate to be used is this particular rate, because this is this company's Vyom Limited who is purchasing RIS company, right? So cost of capital, the discounting rate will be used for what? Vyom Limited now, because Vyom Limited wants to see that the benefit should be more than their cost of capital. Their cost of capital is 15%. They want to see their benefit in comparison to the cost of capital. That is why this discounting rate will be for Vyom Limited, not RIS Limited. Clear? I am giving you the logics here. That's important, sir. So if you consider the total present value of the cash flows is 20.08. Now what I am explaining, listen to it very carefully. Here the fair value, sir, 20.08 is one component of this fair value, is one component, that is the present value of the future cash flows up till 6 years. Up till 6 years. Now, next, what will happen next, sir? Sir, after that, the growth rate is 10%. So, similar thing now we have done in the dividend decisions ICAI module. What, sir? Now, when the growth rate is at a same rate, we can apply the Gordon model. What I will do is, I will calculate the fair value here now. I will calculate the fair value at end of 6th year. What it will be? It will be what, sir? It will be the whatever is the sale, 88.2 plus the growth rate of 10%. Plus the growth rate of 10%, that is, okay, I'll write the formula first for you so that you people get to know that. Right, cash flow of 6th year plus growth rate, that is G, divided by KE minus G, right? So it will be 88.2 plus 10% divided by 15% minus 10%. This will give me what? This will give me the fair value at the end of this particular period. What I will do now, whatever the fair value you get here, right, I will multiply it with what? The present value factor of 6th year at 15%. That will give me what? That will give me the present value, will give me the fair value at 0 period. This multiplication will give me what? The present value at 0 period. Add this value here to get the total fair value. I know you people must be worried, but don't worry. Go through with the dividend decision ICAI module. You will get to know. See here, now he says the present value of the cash flows at the terminal value at end of year 6. What is that? The cash flows at the end of year 6, the figure I think is, okay, cash flow. We are not taking the sales, we are taking the cash flow at the year 6, sir. Right? Plus growth rate divided by KE minus G. KE minus G, cash flows at year 6. Because we are not talking about only the sales, we are talking about the cash flow, right? So 18.96 cash flow plus growth rate divided by KE minus G. So this will give you what? At the end of 6th year, present value of the above. 417.12 is what? The value of the after 6 years. After 6 years, whatever the cash flows will be, it is the present value at the end of that 6th year. 417.12 is what? 417.12 is this fair value. 417.12. It is this fair value. For the cash flows that are going to be at this period, we have calculated the fair value of those period at the end of 6th year. That comes to 417.2. Now, multiplied this 417.2 with what? The present value factor at 15% of 6th year, not 6 years, 6th year, right? You will get the present value. Now this is at 0 period. So fair value is what? The fair value is 20.08 plus this 180.20. This is the total fair value of the RAS Limited. Very important question. Very, 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 very good and very important questions. Oh, so for this, if you have any confusions, go through with the ICAI module dividend decision, sir. You will get a better understanding on that what we have done, sir. Whenever I'm giving again explaining you the hint here that after 6 years, because the growth rate is constant for infinite life, there is no finite life, then we can apply what if you talk about the dividend, we can apply the Gordon model, sir. We can apply the Gordon's growth model. It is applicable only when the growth is constant. Now here we replace the dividend with the cash flows. That's it. We are replacing the dividends with the cash flows, and then we are applying the growth and all. Simple, sir. Dividend growth model says if you want to calculate KE, what is that? That is D1 divided by P0 plus G. I'm saying I want to calculate the fair value or the price. I want to calculate what? The price. So price, what I will do, sir? I will take G here, I will write KE minus G is equal to D1 divided by P0. I'll take P0 here, I'll write P0 is equal to D1 divided by KE minus G, or I can write D1 as D. Now I want what? I want D7 here. D7 here, I'll write D6 into 1 plus growth rate divided by KE minus G. That is what I did, right? This cash flow not 88.2, 18.96. Right, this D6 is what? The cash flow at the end of end of 6th year. At end of 6th year. Growth rate is there, KE is there. So I calculated the fair value at end of 6th year. Then taken the present value of this fair value to calculate the value at 0 period. So I'll multiply it with the present value factor of the 6th year, not 6 years. Present value factor of the 6th year at 15%. I hope this is clear, guys. Very important part. Very important, very interesting, very important, sir. Mark it as important. Okay, let's move on to the next question. Next question is on ratio analysis. This you people can do, sir. This you people can do. Definitely you people can do. Isn't it? I'll give you as homework. Just try this question. He says, from the following information, I'll read it, discuss it quickly. From the following information pertaining to Messrs. Anya Company Limited, prepare the trading profit and loss account for the year ended 31st of March 24 and a summarized balance sheet as at that date. Current ratio is given, quick ratio is given, proprietary ratio, that is fixed assets to proprietary funds. What is proprietary funds? Equity, sir. Right? It comprises of what? It comprises of equity share capital plus reserves and surplus plus preference share capital. Gross profit to sales ratio, debtors velocity is given, sales are given, working capital is given, bank overdraft is given, share capital is given, 2,50,000. Closing stock is 10% more than the opening stock. Net profit is 10% of the proprietary funds. You are required to prepare what? The P&L and the balance sheet. Trading profit and loss account and the balance sheet. See, in these kind of questions, what you should be doing is prepare the blank format, right? Before you start with the working notes, prepare the blank format for the trading profit and loss account and the balance sheet, right? What you should be doing is prepare the blank format, right? Trading and profit and loss account, because you will, sir, how many lines to be kept, sir? That is just the estimate on the estimation basis that what you can do, right? This is your trading profit and loss account. Make this much. Nobody is going to stop you, right? And on the other hand, then you can write a balance sheet, right? In the balance sheet, we can go with the what, sir? In the balance sheet part also, we can prepare the blank format, sir. Prepare the blank format, leave for some lines. Right, go with this thing, liabilities, and here you will have assets. Prepare the blank format, sir, and then start with your working. Then start with your main working, like the current ratio is given 2.5 and the working capital is given. See, from current ratio and working capital, you will be able to calculate what? You will be able to calculate your current assets and current liabilities, right? Current assets and current liabilities. Now, then the quick ratio is given. Quick ratio is given 1.3. What is quick ratio? That is quick assets. That is quick assets divided by quick liabilities. Please be very careful with one thing here. It is 1.3:1. Here, quick asset will be current asset minus inventory, and quick liabilities will be current liabilities minus bank OD. This bank OD is also there, so you have to treat it. Bank OD is equal to 1.3:1. From here, what you will get is, you will get the value of your closing inventory. You will get the value of your closing inventory. That means your current assets, total current assets are comprising of one, inventory. Secondly, the debtors are given to you, that is the current assets will have the debtors also. Sales are given, debtors velocity is given, so you can easily calculate debtors, sir. Debtors by sales into 365 is equal to 40. Isn't it? You can easily calculate debtors, and the remaining will be your cash or bank balance. Clear? And your total current liabilities will have bank OD and the other current liabilities. This you should be careful about. Rest of the calculations you can easily do, sir. Then start posting whatever the value you get, post it in the trading profit and loss account and the balance sheet. Start posting. You get the value of inventory, right here inventory, sir. Post it, inventory. You get the value of debtors, right here debtors, sir. You get the value of cash, right here cash, sir. You have the bank OD, right bank OD here, sir. You get the value of current liabilities, right other liabilities, other current liabilities here. Write it down. Whatever the values you get the closing stock, right here by closing stock. By closing stock, you get the value of opening stock, right here to opening stock. Because it is given, opening stock, this information is given. Now, closing stock is 10% more than the opening stock. Isn't it? So, this is how you have to do it, sir. Will you be able to do it? Just try it once. Right, try it. It is not that difficult. It is not that difficult. I have shown you the path on which you have to move. Rest in the examination also, guys, you people have to move, right? I will not be there to spoon feed you. So I want, why not start practicing from here itself, right? Before the examination, you should have some practice. I'm here to guide you that how you can proceed with it in the examination itself. Clear? Okay, let's continue to B part. Paras TMT Limited is a TMT manufacturing company with a face value of rupees 10 per share. The following information is given about the company. The expected to grow at 10% per annum for the next 4 years and 5% for an indefinite period. Growth rate 10%, 4 years. After that it is 5% for an indefinite life. The rate of return expected by the shareholders on the share investment is 15%. Okay, sir. What is this? This is the KE that is given to you. The company paid 4 rupees as dividend per share for the current financial year. Find out the intrinsic value of the share. Sir, this is 0 period. 1, 2, 3, 4. 1, 2, 3, 4. After that 5, 6, 7 indefinite period. Here D0 is given as 4. For the first 4 years, the growth rate is going to be 10%. After that, it is going to be 5% indefinitely. KE is given as 15%. You have to calculate what? You have to calculate the price of the share at 0 period. Price of share. That is what is the intrinsic value per share. Similar to the previous question, C part, sir. Similar to that, isn't it? What will be the price of the share? The price is the dividend paid here, present value of that. The dividend paid here, present value of that. Dividend paid here, present value of that. Dividend paid here, present value of that. The problem is, after this, the growth rate is constant. Then what to do? You will calculate the price of here, sir. P4. What will be P4? it will be D4 into 1 plus growth rate divided by KE minus G. Clear? Once you get this value of P4, then multiply it with the present value factor of the 4th year at 15%. You will get what? You will get the value of this at 0 period. That will give you the total price of the share. It will have two components. One is the present value of these dividends plus the present value of this P4. Two components will be there. That will give you the total price of the share. Similar to that C part. Homework, sir. Try to do it, right? Try to do it. Good question. I have given you the hint that how you should be proceeding with this. Similar question is there in the module, sir. Similar question is there in your module, right? So please. Now this last question, question number 7. After that it is the theory part which is there. Oh, sir, question number 7 is too huge. Yes, it is a very good question. Mark it as very important. And this question is on what? This question is on factoring. This question is on what? This question is on factoring. Very good question. Important question, right? You will get a lot of perspectives in this question. Zomo Limited currently has a turnover of 120 lakhs, 75% of which is on credit. So can you tell me what is my credit sales? I'll write it side by side. 120 into 75%. So this will be my credit sales, sir. 90 lakhs. Fine. The variable cost is 80% and the credit terms offered is 2 by 10, net 30. On the current sales volume, the bad debt is 1% and the company spends 1,20,000 annually on administrating its credit sales, including the staff salaries, and this costs are avoidable. This is the credit administration cost of 1,20,000 and it is avoidable, sir. In addition, 60% of the customers avail 2% cash discount. Very good, sir. Good, very good. And the remaining customers, that is 40%, they take 60 days on an average to pay after the date of sale. After the date of sale, they normally pay within 60 days, sir. Good. The book debts are financed by a mix of bank borrowings and own funds in the 1:1 ratio. Now he says, because sir, the debtors are taking time, right? There is an average collection period. So for that period, I need money for working capital. How will I take that money, working capital? By the bank borrowings in the ratio 1:1, that is debt equity ratio. With the annual cost of 15% and 14% respectively. This is what the company is currently doing, right? This is the situation of debtors. Now, however, Zomo Limited is also considering dynamic discounting. Is considering what, sir? It is considering the dynamic discounting for its cash customers, which might incentivize more customers to pay earlier by increasing the discount rate. This could lead to a potential reduction in the bad debts to 0.8%, but may also increase the cost of the discount offered to 2.5%. So they are thinking that let's increase the discount percentage so that more customers feel like, okay, there is more discount, let's pay earlier. Sir, we all people love discounts, isn't it? We run after the discount. So they say, but the cost of the discount will increase, definitely. Now, this is one option, sir. The second option is, this is one option that they can go for dynamic discounting. That is, they can increase their discount so that to move more customers to pay earlier, to lure more customers into paying earlier than the dates. Okay, this is one option. Another option is factoring. The factoring firm has proposed to deal with the following terms: factoring reserve of 12%, it is not reverse, again it is reserve, sir. Guaranteed payment 25 days, interest charges 15%, commission 4% of receivables. Now I want to ask you one thing, sir. Sir, interest of 15% is to be paid for how many days? Sir, 25 days only. Remember, factoring. Sir, he is going to advance this money for 25 days only. After 25 days, the factor will receive the money now. After 25 days, the factor will receive the money from the debtors. So he is advancing the money. Whatever the advance is, he is advancing for at a point of time, he is advancing for only 25 days. Interest he will charge for only 25 days. Remember this. Now, this is option number 2. This is option number 1. This is option number 2. There is another third option with the company. The company says, in addition, the company also has the option to extend the credit period for its remaining customers who do not avail the discount to 75 days. How many customers are there who do not avail the discount? That is 40%. So for this 40%, they says we will increase the credit period to 75 days instead of how many days? 30 days. They are paying in 60 days normally, but we want to extend the credit period to 75 days. But there is a condition. Condition is what? Which might increase the sales by 10%. Yes, sir. The customers will be very happy, sir. The customers will be very happy that we are getting 75 days instead of 30 days. We are already paying in 60 days. Okay, now we are getting 75 days. We will pay in 75 days. We will not pay in 60 days also now. We will pay in 75 days. Why not utilize the full period? But the company is also smart. The company says, okay, we will increase the period to 75 days, but at the same time, if you pay, but could result in the increase in the bad debt to 1.5%, right? Increase in the bad debt to 1.5%. The bad debts can increase because now people are enjoying more period. Given the cost of fund expected to rise 16% next year, one thing, Zomo Limited plans to introduce late payment penalties for customers who take more than 60 days at 5% of the outstanding receivables. Look at this condition. Now, if you are a debtor, you are a customer, you will say, sir, you are giving me 75 days period. I will pay on the 75th day. Now, why should I pay earlier? I don't want the cash discount. I will pay at the end of 75 years. The company says, Zomo Limited says, okay, it's okay. Pay me at 75 days, but after 60 days, you will have to pay me 5% penalty. Company is also smart. Company is also smart, isn't it? On one hand, they are increasing the period to 75 days. And at the same time, they say, if you do not pay by 60th day, we will charge 5% penalty. Assume 360 days in a year required. Should Zomo Limited opt for dynamic discounting, that is option 1, or the factoring, that is option 2. So we will have to see what is the cost under dynamic discounting and what is the cost under the factoring. Forget about the last third option. They are asking about only the first two options. If you go for the dynamic discounting, what will be the cost that you will have to bear? Let's talk about only the cost part, sir. Sir, one will be the bad debts part, 0.8%, right, of the credit sales. Credit sales is how much? 90 lakhs. Fine, sir. Then, sir, credit administration cost will be there. Yes, sir, 1,20,000 credit administration cost will be there. I am talking about what? I am talking about the dynamic discounting. What will happen in case of dynamic discounting, sir? What will be the cost? One of the cost will be my bad debts, right? That will be 0.8% of 90 lakhs, right? That will be 0.72. Clear? Into 0.8%. Correct, sir. 72 or 72,000. That will be bad debts. Sir, will there be credit administration cost? Yes, sir, there will be credit administration cost. How much? 1,20,000, because dynamic discounting doesn't mean that you are giving the debtors to someone. No, you are yourself managing the debtors. At the same time, what will be the cash discount? Third, your another cost will be what? The cash discount, sir. What will be cash discount? Out of 90 lakh, 60% customers avail the cash discount. Right, and what is the percentage? It will be 2.5% now. So 90 lakh, 60%, that will come to 1,35,000. So this is another cost that you will have to bear. What else will be the cost? Sir, you will have to arrange the working capital, you will have to take a bank loan and own funds in the ratio 1:2, right? That is what? On the average receivables, you will have the cost of carrying the receivables. Another cost will be what? Another cost will be the cost of carrying receivables, right? Receivables. Now, cost of carrying receivables will be what? It will be the average receivables into average collection period by 360, isn't it? First we have to see what? Sir, for the average collection period, what is my investment in the receivables? For that investment, I will take debt also and I will use my own funds also. So first I want to know that for the average collection period, what is my investment in the receivables? According to that investment, what is the amount that is invested from my pocket in the receivables? According to that investment only I will take a bank loan and equity, isn't it? I will take the borrowing according to the investment. So what is the investment here? What is the average collection period? Now, I told you, sir, when the discounting part is there, in that case, what will be the average collection period, sir? Sir, 60% of the customers pay within 10 days. And the rest of the customers, that is 40%, they pay in 60 days. So what will be the average collection period, sir? That is 6 and 24, 30 days. 6 plus 24, that is 30 days. Right? What is my receivables? Receivable is 90 lakhs into 30 by 360. Right? So 90 lakhs into 30 divided by 360, that comes to 7,50,000. Now for this 7,50,000, I will take debt and own funds, right, in the ratio of 1:1. So how much will be the debt, sir? 3,75,000 will be the debt and 3,75,000 will be my own funds. And what is the cost here now? What is the cost of debt and own funds? It is given 15% and 14%, bank borrowings and own funds. So it is 15% and 14%, right? That will come to 56,250 and 3,75,000, 14% of it will be 52,500. So this will be another cost. So what is the total cost now? The total cost here is 72,000 plus 1,20,000 plus 1,35,000 plus 56,250 plus 52,500. This is the total cost if you are going for the dynamic discounting. Clear? If you are going for the dynamic discounting, this is the total cost that you have to bear. Let's see the solution now. See here. If you are going for the dynamic discounting, cost of discount, that is 1,35,000. This is what we have calculated, sir. 1,35,000, correct, sir? Okay, I'll check it from here. Cash discount is there, bad debt 72,000 I have calculated, sir. Admin cost is there and cost of financing the receivables is there. This cost 56,250 and 52,500. This is what we calculated, right? So this is the total cost that the company will have to bear if they go for the dynamic discounting. They are themselves managing the receivables. They are only increasing the cash discount. Clear? Now, next part, sir. What is there? Factoring. Factoring says proposed a deal. Now what is the terms with the factor? The factor says, first of all, I will charge a commission. I will charge a commission of 4% of the receivables, right? So what will be the commission amount? Commission amount will be 4% of what? 90 lakh rupees. Okay, sir. 90 lakh rupees, 4%, 3,60,000. Who will pay this amount? The company will pay now from its own pocket, sir. Okay, sir. Now, out of 90 lakh rupees, 3,60,000 is gone. 3,60,000 is gone for the receivable, sir. So 90 lakh minus 3 lakh 60,000. Now 86 lakh 40,000. This is what the factor can pay. But the factor says out of this I will keep 12% as reserve. So what is 12% of it? That is 10 lakh 36,800 will be the reserve, and the advance money will be 76 lakh 3,200. On this, interest will be charged at 15% for 25 days. So what will be the interest amount? Interest amount will be 79,360. This is my interest cost. This is what? This is my commission cost. Right? Factoring commission cost, interest cost. Two costs we have discussed. Sir, will there be any other cost if we go for the factoring? If we go for the factoring, will there be any other cost, sir? Just tell me that. Will there be any other cost? Yes, sir. There will be another cost. What, sir? Sir, the amount which the factor has not paid to us, for that we will have to go for what? The bank borrowing and own funds. Right? What is the amount factor has not paid? The amount that the factor has not paid, that is 10 lakh 36,800, which is kept as reserve, right? Which is kept as reserve, plus this 3,60,000 also, the commission that you have to pay to the factor, for that also you need the money, na sir, plus 3,60,000. So 10 lakh 36,800 plus 3,60,000, 13 lakh 96,800. For this you will go for this you will have to put it from your own pocket. Okay, see here, own funds, cost of own funds. Now this you will have to put it from own pocket, sir. You can't go for the bank borrowing. Right? Otherwise you are paying the interest to the factor also. He says the cost of own funds. The rest of the money will be from your own pocket, own funds. This is what we have calculated at 14% for 25 days. Obviously it is going to be for 25 days only. So 13,580. So three costs are there related to the factor. What are the three costs? Factoring commission, calculated sir. Interest, calculated sir. Cost of own funds, that is besides what the factor is giving, we will have to go for the own funds. Now here with the interpretation we can play in one thing. One thing we can play with, that they are saying that this is own funds, whereas we can say that for this we can go for the bank borrowing also. This is another interpretation of the question. 50% we can go for bank borrowing and 50% we can go for the own funds. In that case the answer will change. Yes, that interpretation can be there. Right? That whatever the money which is not provided by the factor, that money, for that money we can go for the bank borrowing and own funds combination in the ratio 1:1. We can go for that. That is another interpretation of this question. Another interpretation which is 100% correct. Which is 100% correct, sir. Right? So this is dynamic discounting versus the factoring offer. Now what is there? In case of dynamic discounting, the cost is 435,750. Here the cost is 452,780. So the company should go for dynamic discounting. Cost is less. The second part says, this says, analyze the impact of extending the credit period on the company's finances. Right? That is, now he is talking about option 3. What will be the impact here? In option number 3, what will be the impact? Sir, the impact will be 1, the bad debts cost will be there. If you talk about option 3 now, what is the cost that is there in the option number 3? 1, the bad debt cost will be there. Yes, sir, the bad debts cost will be there. How much will be the bad debts cost? That will be 1.5% on 90 lakhs. On 90 lakhs, 1.5%. Right? On 90 lakhs, 1.5%, that comes to 1,35,000. Clear? 1,35,000 will be your bad debts cost. Then credit administration cost will be there. Yes sir, credit admin cost will be there. That will be 1,20,000, no doubt about it. That will be there, isn't it? Credit administration, you are managing your debtors sir. So there will be administration cost. Then what else will be there? Cash discount will be there. Yes sir, cash discount cost will be there. Cash discount cost will be there. So on the total debtors, 60% avail the discount, and what is the discount? 2%. Here it is not dynamic discounting, it is the normal discounting that we are going for, because it is not mentioned in the third part that when they are extending the credit period, along with that they are going for dynamic discounting. No, it is not mentioned. So we are going for the normal discounting. Okay, 90 lakhs, 60% customers, right, into 2%. That will be 1,08,000 cash discount, right? Now what will happen sir? Just try to understand. You will charge penalty also. Now penalty will not be a cost. Penalty will be what? The cash inflow. It will be a inflow of money. Rest everything we are talking cost sir. Here I'll talk about cost. Sir, 90 lakh customers, 40% will pay on 75 days because they are getting the credit period. So what is the penalty that you will charge? Penalty is 5% penalty you will charge from them. So 90 lakhs, 40% into 5%, that is 1,80,000 is the penalty that you are planning to charge sir, right? But here you will have to see one thing sir. Here you will have to see one thing, that what sir? Penalty will be 1,80,000. Wait, cash discount is there, bad debts are there, we have already discussed, right? Cash discount we have calculated, correct sir? No, cash discount also we have not, something is wrong with the cash discount calculation, since there is no, okay sir. One thing that we missed was the sales increase. If you are increasing the credit period, your sales will not be 90 lakhs now. There is a 10% increase. So the sales will be 99 lakhs. So here the calculation is to be done with 99 lakhs. Sorry, 99 lakhs. So even the bad debts cost will not be same. Here also it will be 99 lakhs. Here also it will be something different, sir. What will be the bad debts now? 99 lakhs into 99 lakhs into 1.5%, that comes to 1,48,500, right? And cash discount will be 99 lakhs. So it is according to that only, into 60% into 2%, that is 1,18,800. So here also it will be 99 lakhs, 40% customers and 5% penalty. 1,98,000 is the penalty that you are going to charge. Now let's see the third option. Let me highlight. The sales we have calculated, penalty 1,98,000 we have calculated, bad debts is there 1,48,000, cash discount we have calculated, bad debts he has calculated again, sir. Administration cost I have written 1,20,000. Now another thing will be cost of financing the receivables. Another cost will be cost of financing. Now this cost will be, now this is, I'll take it as negative because it is opposite to a cost. It is what? It is a saving. It is not a cost. So I'll take it as opposite to a cost. Another will be the cost of receivables. The cost of receivables. How will we calculate, sir? Receivables into average collection period divided by 360. What will be the average collection period, sir? Average collection period here will be 60% customers will pay within 10 days and 40% will pay in 75 days. Right? Plus 6, that is average collection period will be 36 days here. So receivables are 99 lakhs into 36 divided by 360. Right? 99 lakhs into 36 divided by 360, that will be 9,90,000. That will be 9,90,000. 90,000. Now this money you will arrange in the form of debt and own funds in the ratio of 1:1. 4,95,000. 4,95,000. What will be the cost? 15%. Here it will be 14%. 74,250. And here it will be 4,95,000 into 14%. It will be 69,300. So this will be total is how much? Plus 74,250. Total will be 1,43,550. Right? So let's see what all cost is taken here. What all cost is taken here. Total cost calculation with the extended period. 1,18,000 cash discount, net bad debts after penalty. This is what? This is the bad debts minus penalty. That is what they have taken. So that will come out to be negative because penalty is a inflow. That is what I told you. Penalty is what? Inflow. Administration cost, cost of financing the receivables, 143,550 total cost. Final decision. This is option 1, option 2, option 3. What you should be doing with? Go with the option 3, that is the extended credit period. Go with that because that is containing the least cost. Brilliant question on factoring and on receivables, one of the best questions which the ICAI has asked. Brilliant sir, मजा आ गया इस क्वेश्चन में, मजा. Right, so please go through with question number 7 again. I have given you the detailed workings. I have given you all the workings individually. Dynamic discounting, then what is to be done in case of factor, then what is to be done in the third case. In the third case, we missed one point, that was the increase in the sales by 10%. This point you should be considering, sir. With this, we are done with this particular MTP, and whatever the homework I have given, please do that homework. Do not miss out on the homeworks, which is very important, right? So we are done with this MTP January 25 Set-01. See you guys in the next video. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.